personal finance segment, and Trade is ready.
Good afternoon, Nikunj. Well, interestingly, what we haven't noticed while we've kept our eye on the equity market is that debt fund returns have turned around in the last month or so, and they're looking quite strong. If they continue like this over the last 6 months, they've given between 5 and 6%, which means if they continue like this, we're looking at double-digit returns by the end of the year. So for some of our more conservative viewers, it might make sense to take a look at debt funds, which means I have to bring in Dhirendra Kumar. Dhirendra, thank you for joining us. There's been a turnaround in those returns. Medium to long-term gilt funds have given 6.03% in the last 6 months. Income funds have already given to 5.26% gain in 6 months as well, which means that we are looking at double-digit returns by the end of the year if it continues like this. Tell us what the cause of this turnaround has been.
The cause, I would attribute this turnaround. I would not say that this is a big turnaround. You know, this is a kind of return which is 20% more than what you will earn on a one-year term deposit. So in that sense, it is not a huge return. But certainly, you know, it's a decent return. And I would attribute this return enhancement, or, you know, a little improved return to primary thinking that interest rates are unlikely to go up. So once the RBI governor has stated that interest rates will not go down, and they may not go down in a hurry, but the very comfort that investors derive, or, you know, the fixed income investors, the people who buy bonds, so in that sense, that has been the primary cause. But at the same time, I would say that don't get impressed by these numbers. Debt funds, because they are rooted in reality, you know, fixed income funds, they invest in bonds. The attributes of a bond are very well clearly laid out. You know, you very well know what is the quality of the bond. It is also quantified, somewhat quantified in the form of a rating. You also know the tenure, and you know the coupon. So bonds cannot really behave like equity, and bonds cannot really crumble like equity sometimes. So in that sense, bonds do work in a certain range, and that provides it the range which one can say that you have greater predictability. And whatever happened in the last 2 years, you know, a year and a half back, that was very disappointing. And that is something which can't be ruled out, because I don't think the world has changed from the dynamics has changed. So nasty surprises coming, and you can't rule that out. So investors should be wary of, you know, trying to benefit from the enhanced return of fixed income funds.